If you own a business either online or brick and mortar, chances are you've heard of the term closing your books. This refers to the process of verifying the integrity of your accounting records, or reconciling, and ensuring that everything is accounted for. From your accounts payable and receivable to making sure your inventory matches, there's a lot to do. Daunting, huh? When you think of year-end, the last thing you probably want to be doing is spending your time closing your books and accounting. But tidying up your system of record is more important than you might assume, and you should be doing it a lot more often. Let's take a step back and consider why a business owner would even go through the trouble of closing their books. The term closing your books comes from the days where you were required to manage a physical accounting book, whereas now almost everything is done digitally. This process serves to finalize data to be used for reporting and notify management so they can analyze the cash flow and make future business decisions. Think of it as a final stamp of approval before locking the books to make sure nothing can be changed in a given time period without password approval. The entire purpose of a system of record like QuickBooks is to ensure that all of your transactional data and inventory is managed in one place and prevent risk of audits. Meaning you should be pulling all of your in-store and online orders, managing expenses for inventory, shipping, and processing, and keeping track of things like discounts, refunds, and credits. Sounds easy enough, right? Kidding. There's obviously a lot that goes on behind the scenes when it comes to your accounting, let alone the rest of the business. Once your business starts to get traction and orders start to pile up, so does everything else along with it. That's why you want to make sure you're starting from a baseline as often as possible. This baseline can save you a lot of time and frustration in the long run. But closing your books isn't something that you should just be doing at the end of the year. In fact, when we talked to Lori Walsh, who's a partner with the experts over at 4Lane, she had this to say.
I recommend monthly, but at least at the end of the year. If we do it monthly or quarterly, right, we're looking at those numbers to make sure that they make sense sales-wise. Most people know kind of where their sales are, right? They can kind of get a feel, but if they're looking at it in a whole year as opposed to a bite-sized piece once a month, it's a lot. I personally will recommend monthly, minimum quarterly. We do see a lot that do it yearly.
How often a business closes their books is entirely up to them, with some closing monthly, some closing quarterly, and some never closing their books at all. The time it takes to finish this process can also vary. With fees and payments, you're not guaranteed to receive them by the last day of the month, which can push the time it takes to close everything out. But overall, it's good to shoot for a 7 to 10 day window when closing.
I usually just say it should take about a week and a half. And that way we're making sure that the transactions pertaining to the prior month are accounted for. We've reconciled inventory. We've, reconciled all of those balance sheet accounts. Bank accounts, another one, right? We don't get the bank statement till the day after the month ends in some cases. So we want to make sure, because if the cash is right and all of those other balance sheet accounts are right, that at least hopefully means all of our expense accounts are there.
You might ask yourself, when should I start closing my books if I'm looking to do this monthly? By starting the closing process on the first calendar day of any given month, that 7 to 10 days should give you ample time to make sure any recorded transactions are accounted for, and allow you to wait for any additional fees or payments to pull in. Now, it's not required for a business to close their books regularly, or even at all. There's no laws or regulations forcing businesses to do these audits and ensure that data is flowing correctly. However, just because you can get away without closing your books doesn't mean you should. Businesses that close their books regularly generally have a much better understanding of their overall financial performance in any given month. By closing your books, you'll be able to guarantee that your data is accurate and make pivotal decisions without fear of missing the big picture. Not to mention the tax implications when you send records to the IRS that aren't accurate. There's no such thing as being 100% audit-proof, but closing your books regularly will most certainly lessen the blow when you know you have a paper trail to back you up. For those new to the concept, or want a surefire way to get this done, let's go over the steps to closing your books properly. 4Lane suggests asking yourself a couple questions to determine if you're ready to start the closing process. Have I sent any remaining invoices and recorded income? Have I paid all remaining bills for the month? Have I collected and categorized my business expenses? Have I counted my remaining inventory? Have I checked my account balances against my bank statements? If you said yes to all these questions, you should be ready to knock out the closing process pretty easily every month. You'll want to start by posting and recording all of your transactions across any sales channels or marketplaces you have, and boil it down to what matters, the totals and amounts. After you've posted the transactions, you can then disperse them amongst your general ledger accounts. This includes assets, liabilities, equity, income, revenue, and expenses. You can get further granularity here by sorting them into the subledger accounts, like accounts receivable, vendor accounts, or sales accounts. From here, you can calculate your profit and loss using a P&L report. This report will show you all of your revenue and expenses for the accounting period, totaling everything up to give you a final figure that shows your net income for that period. All that's left to do from here is create closing entries and your final trial balance to effectively show that everything has been zeroed out. Closing entries are journal entries that will move your income and expense balances over to their permanent ledger or subledger accounts, which should give you a fresh start come the next accounting period. Lastly, you can run your final trial balance report, which should reflect the movement of your balances and total everything to zero, and all that's left to do from there is set a closing date in QuickBooks to ensure no further entries are recorded without password authorization. There's a lot that goes into making sure you have a proper paper trail in accounting. But that doesn't mean there aren't ways to make the process easier along the way. For example, accounting automation software like Webgility can automate your journal entry or transaction posting and inventory adjustments, as well as many expenses so that you don't have to put that data in manually. It can even post these amounts directly to the subledger you've assigned. From there, it's simple as reconciling or double-checking the integrity of the data to make sure that everything looks right. Additionally, our friends at 4Lane can help you set up workflows and clean up your company file. This can come in handy for those of you that don't know where to start, or feel like I may have been speaking in another language this whole video. For a more detailed write-up on this topic and everything that we covered, click the link in the description. And remember that it's never too late to start the process of regularly closing your books.